Welcome to The Explainer. If you're navigating the crypto markets, it's incredibly easy to get fixated on just one thing, right? The price. We all do it. But seasoned investors know the price tag is really only half the story. The other half? Well, it's the supply. Today, we're unpacking an absolutely crucial, yet often completely overlooked metric that literally dictates the actual value of your investments. We're talking about total supply. So picture this. A project mints 100 million tokens. You pull up the exchange data, but wait a second. Only 60 million are actually trading. So where are the other 40 million? Are they lost, stashed away in some digital vault somewhere? And more importantly, does it actually matter to you? Absolutely it does. Those missing assets are what we call locked tokens. And if you're ignoring them, you're basically investing blind. Okay, let's dive into this and define exactly what total supply actually is. Simply put, it's the sum of all coins or tokens that currently exist within a specific project. This includes the coins actively circulating out there in the market, plus all the locked coins reserved for the founding team or maybe future development. But, and here is the critical distinction, it does not include permanently burned tokens. So your master formula is essentially this. Total supply equals all existing coins minus any permanently burned coins. To really cement this, think of a massive retail business. Let's say a company manufactures 100,000 products. Some items are out on the store shelves right now, ready for you to buy. But the rest? They're just sitting in the back warehouse. They exist, sure, but they aren't available to customers just yet. In crypto, circulating supply represents those store shelves, but total supply? That's your entire inventory, the shelves plus the warehouse. They both matter, obviously, but they tell very, very different stories about the asset. Let's see how this actually builds into a real calculation. Step 1. A project creates 200 million coins. Step 2. To increase scarcity, they decide to permanently destroy or burn 20 million of them. Remember, those burned tokens are gone forever. No getting them back. Step 3. We simply subtract those burned tokens from the created tokens, which leaves us with a true total supply of 180 million. Even if some of those 180 million are locked up in our proverbial warehouse, they still count because, well, they technically still exist. The 3 supply numbers, clearing up the confusion. And this brilliantly illustrates the big picture. When you open any crypto data site, you're generally going to see 3 different metrics side by side. First up, circulating supply. This is the smallest number. It's only the coins available to the public right now. Second is total supply. As we just covered, this includes both the circulating coins and those locked warehouse coins. Finally, the largest number, max supply. This is the absolute lifetime ceiling of coins that can ever exist for that specific project. No exceptions. Bitcoin is actually the perfect real-world anchor for this concept. Its max supply is permanently fixed at the famous Bitcoin 21 million limit. That's the lifetime ceiling. Right now, new Bitcoins enter circulation gradually through mining rewards, right? So Bitcoins circulating and total supply are both slowly growing over time, essentially filling up that fixed maximum limit. This highly transparent, totally predictable structure is exactly why it's treated as digital gold. Now, you got to keep in mind that total supply is highly dynamic. It goes up when new coins are created. That could be through mining, staking rewards, or scheduled releases of those locked tokens we talked about. Conversely, it goes down when projects execute token burns, basically intentionally destroying their own coins to improve long-term scarcity. Tracking these upward and downward movements, it's absolutely vital for evaluating a project's true economics.
5 common beginner mistakes to avoid.
So the crucial point here is to protect your portfolio. Let's rapid fire through these mistakes. Mistake 1, judging a coin by price alone. Look, a 1-cent coin is definitely not a bargain if its supply is a trillion. 2, confusing total with circulating supply. 3, and this is a massive, massive danger, ignoring future token unlocks. If a huge chunk of locked tokens suddenly hits the market all at once, yeah, it can tank your investment literally overnight. 4, assuming a high supply is automatically bad. Utility and demand matter just as much. And 5, ignoring token burn mechanisms, which can drastically improve a project's long-term value. Okay, let's lock in the essentials with a quick recap. Point 1, total supply equals all existing coins minus any permanently burned tokens. 2, it includes both circulating market tokens and those locked warehouse tokens. 3, don't confuse it with max supply, which is the absolute lifetime ceiling. If this explainer helped you decode these metrics, definitely hit subscribe as we continue to build out your premium investor toolkit. Now, before you go, I want to leave you with a quick thought. Pull up your crypto portfolio right now. Do you actually know the true total supply of the assets you're holding? Or are there millions of locked tokens waiting in a warehouse somewhere, getting ready to flood the market when you least expect it? Take 5 minutes today and go audit your holdings. The answers might seriously surprise you. Thanks for watching The Explainer, and keep learning.